Welcome back, everyone, to another episode of Ready, Aim, Retire. Rob Kirvan here, your host. It's a show where we go through life, go through your wealth management, kind of try to find different ways we can help you just build your financial future. And today, wow, we hit a home run, Tony.
Huge.
Tony, we hit a home run. We hit a home run today. So today we have Michael Binger, the president of Gradient Investments, and it's kind of special. Mike, first of all, welcome.
Thank you for having me. I appreciate the really warm introduction there. That's great.
Yeah. Well, yeah, and you know what? I feel people that listen to this have known you. You've come to our events, I don't know, 10, 12, 14 years for a long time anyway, but
twice a year for a long time.
Twice a year for a long time. And we've done some sub ones. You remember the one we did on the what did we do? Rented a bus and we went to
we had the brewery tour. Penrose. Yeah,
Penrose. Oh my goodness. Yeah, Penrose.
Yeah. We did a farm thing. I'm not sure if that was the summer party or
that was the COVID breakout party, actually.
Okay.
That was the first party for a year and a half. Like normally we do, several a year, but I want to bring up the point that we're recording this on Thursday, December 5th. Which happens to be the night of our client party.
Yes.
And no one's going to hear this. Well, no, they'll get the podcast tomorrow, but they're not going to see us, live and in person until next week. But they're going to have the shock of their life tonight, Mike.
Yeah. Unfortunately, I couldn't make it this year. Had a conflict, but look, we have a solid bench here at Gradient Investments. They're going to be introduced to Mr. Keith Gangle.
Right.
And he's done a bang up job the last 2 years with the Core Select portfolio. He and I worked together, way back, starting at Lutheran Brotherhood and Thrivent, and now here at Gradient. So I'm a little worried that I may not get invited back after he.
Oh, geez. Oh.
Yeah.
Well, he has been on the show and he did a bang up job on the show too. So he has been on here before, but Binger, we always have a warm seat for you. Don't worry about that. Good. All right. You're irreplaceable, as far as we're concerned. And to go along with that, you may wonder, I don't know how well you can see it, but I'm wearing a hoodie today, which normally I would not be wearing a hoodie on the show. I'd wear, dress, not near as nice as you guys, but somewhere close. But I'm in the running back and forth getting this party organized because we'll probably have 300 plus clients there tonight. We got live entertainment. We got Cal's Angels coming in. That's a charity of choice. So a lot of action today. So we're carving out, like 30 minutes here because we got some good action to talk about. But,
yeah, I remember those first holiday parties were, at Bolingbrook, and it was I think the first one was at a restaurant in Oakbrook.
What was that called? Because it's actually not there anymore.
The clubhouse or something.
Clubhouse. Oh, your memory.
Yes.
They're bigger. No wonder you're
the president. Yeah, you had a comedian, you had an open bar.
Yep.
Good food and about 40 people. And now we're up to what? 350.
That can make it, right? Like, so you got to think like this time of year, and it's a blessing and a curse, but this time of year, people have prior commitments, especially this year, because it's a tight holiday season window coming off of Thanksgiving. You got like 3 weekends before the holiday, right? So, so unfortunately, we do have a lot of people that aren't able to make it, but it's a blowout. 100% for sure. So you're right. We've definitely come a long way over the last decade and a half.
Well, you make sure to give everyone my best tonight. I wish I could have been there, but you'll be in good hands with the folks that are going to be there.
We will, and we will miss you. We will miss you. So onward and upward. So wow, we're sitting here, in December. So I like to, what I want to do today is just kind of get some thoughts from you, about, hey, what happened this year, and then some thoughts going forward. So I have some questions that people have given me and clients have given me, and I thought, hey, I'll pass them off to the guy that knows the most about this stuff. So the first thing I want to hit you with, Mr. Binger, is what surprised you the most about this year? Because it's been a pretty good year in the market.
Oh, yeah. Yeah. I think the thing that surprised me the most is just the strength of the market this year. I mean, we've had back-to-back years of 25% returns in the market. That's surprising. But now that we look at it, things like the strength of earnings, a few themes like artificial intelligence, We've had the Mag 7 stocks, and we all know what those are. Netflix, Nvidia, Microsoft, Apple, those stocks that have led the market.
Mm-hmm.
But the overriding theme of artificial intelligence, I think, is what's really surprised me the most. That I didn't think we'd hit that inflection point yet there, and we have. Where people thought, what's this artificial intelligence going to do? Is it going to take my job? And frankly, I think we've transferred to a kind of a position where if you're not using artificial intelligence, you're going to lose your job. So,
right.
Yeah.
Good point.
Yep.
Now, you guys utilize that at all at grading investments?
Yeah, we do. I mean, I've always said that things are easier to edit than to create. So we do. We put out a lot of investment content, but we may use a little AI, ChatGPT, to help us get there.
Okay.
We've started to implement it. I mean, we're in the early stages ourselves, but as far as billing processes and some of our functions and things like that. So yeah, and we actually are looking for ways and companies to partner with an AI on how we can use it to make our business more productive, which makes all the people that we partner with, like yourself, makes their businesses easier and more efficient and more productive.
Right, and that's probably the key theme on it, right? So AI, it sounds scary in the beginning, but the more I see of it, it's efficiency. It just makes things move quicker, move smoother in our environment. I'm not sure about all the other environments, but it certainly makes things more efficient.
Yep. Yeah. You look back, I mean, the internet scared people, I mean, heaven forbid you would buy a book, on the internet, or book an airplane flight on the internet. I mean, that all scared people, putting your credit card out on the internet, all those kind of things. And, having cloud computing where, you didn't have your computers in a glass room in your building, all these things.
Sure.
It's always scary, but, once they get implemented and they kind of hit that inflection point, people go like, this is great.
And that's a good point. So I from our business, I remember a couple of years ago, we said, you know what, we have to get client files. They have to be in Microsoft One. It's a process. Like, that is a daunting process. But the pushback I got was like, oh my gosh, no, you need to have the paper file sitting here. And we have, as you can imagine, cabinet upon cabinet, upon cabinet.
Yeah.
And my thing was always like, we're going to go to the doctor now. They give you the My Chart. There's no file anymore. And there hasn't been for years. They were kind of ahead of that curve a little bit. So we went through those growing pains. And I can tell you now, I don't know what I would do without Microsoft One. No matter where I am, a client calls, I can pull up their file. I can pull up every conversation, things that we're working on, things we're helping them out with, that aren't really, they're not always top of mind. You have to see it. And I can't carry around, a file cabinet everywhere I travel. So I'm proof of concept on that one for sure.
Yep. Don't fight progress.
Don't fight progress, right? You got to embrace it, and my grandfather once said, he was, when he passed, he was 101. I remember asking him when he was like, I don't know, 95, 96, what his biggest regret was. And it was not getting a computer. Like, he's like, what? I kind of thought like no one's going to use these computers. And, I look back, that's one thing I should have learned in life, so.
Right.
Yeah. He was a fighter, and, all right, next thing up.
Yeah.
I like to get sidetracked here, but what were the major drivers? So you mentioned AI, but let me ask you this, Mike. I remember up until, I want to say, the beginning of July, you guys have a portfolio there that's been very popular, very successful, over the years, called the G50, which is a dividend paying stock portfolio. And I remember looking at that and clients that I have in it, and we're doing reviews in July going, wow, this thing is so underperforming. I think it was up like 2% at that point, and the market was up 12 or 13 or something. What a role reversal, because I had someone in yesterday who was up 17. So is this broadening out, kind of, talk to me about that. Is that like something you guys thought was coming, or is it something that is going to continue on?
Well, frankly, that's something we were banking on actually here, and we postured in that way in our portfolios because, the probably the top 10 stocks in the market that were leading the market and providing, the majority of the returns of the market, those were 10 stocks, and we all know what they were. Nvidia was the leader there and the poster child of that.
Sure.
But, trees don't grow to the sky. And eventually, these stocks doubled and all that, and they kind of stalled out. So you either kind of stall out the market itself, or the other 490 stocks in the S&P 500 start to broaden out. And that indeed has happened in the past, I'm going to say 4 or 5 months, where, bank stocks are starting to contribute, healthcare stocks, industrial stocks have started to, contribute. So it hasn't been all just technology stocks this year. We have seen a broadening out of the market. And I think as we look into next year, we may see some further broadening out in the market, where it's not only, some of these other sectors, but I like to look at market caps too. So, I mean, these Magnificent Seven, top 7 stocks, they're all like super mega cap stocks, biggest of the big. But there's a whole universe of small and mid cap stocks that have woefully lagged. And I think we may see them start to broaden up and contribute to the market returns.
Okay, great. Now, what's Gradient do to adjust? You have several strategies, but what do you guys do to adjust strategies, like when you're seeing these market conditions or seeing things going forward?
So keep in mind that each portfolio we have, and we have 30 different portfolio models here, that our portfolio managers manage. So each model has its own set of objectives and long-term goals, strategies, a universe that it can invest in, and select stocks from those kind of things. So number one, that I want the portfolio managers, and just to put it simply, to stay in their lane for this portfolio. Say the G50. If people are invested in the G50, they want dividends, and they want value stocks, and that's why they're invested there. So I don't want our portfolio manager for the G50 going out and chasing Nvidia, or chasing, the latest hot stock. That's more for Keith in the, in the growth area, in the G33, that kind of thing. But as they look internally and the universe of stocks they can invest in, they can, overweight or underweight sectors. They can overweight or underweight stocks, depending on how offensive or defensive they are, depending on, what they see on the economic landscape, depending on where they see corporate profits growing the most, those kind of things. So there is ongoing or active management of sectors and stocks and ETFs inside each portfolio. And that's what they do.
And let me ask you this, Mike. So you one of the most popular portfolios that our clients have utilized is called the Tilt portfolio, and it has a variety of different risk profiles inside of that. So inside of that Tilt, you have 5 or 6 of these standalone strategies kind of working together, in there. So in a year like this, do you guys adjust like different weightings of different portfolios, or how does that work?
We do. So in the Tilt series, remember there's 4 models. So first of all, depending if you're a conservative, balanced, moderate growth, or growth investor, you would be steered into one of the 4 Tilt models.
Okay.
And let's say you're a growth investor. Now you're in the 100% equity or market exposed model, our growth model. So it really is the philosophy of the fund of funds. And you want to think of these models as the fund of Gradient funds. So our portfolio managers, are going to get together periodically, and that's generally once a week. And they're going to say, where do we see opportunity and where do we see risk in the individual portfolios that they manage? And if they see something like the Core Select has done very well, and it's up close to 30% this year, they may say, you know what? In our Tilt model, let's sell some of the Core Select and let's buy the G50 and increase its weighting in the Tilt model, because we see the market broadening out. So that's what they do. So you get 2 levels of active management in the Tilt models. You get, number one, the investment team looking at the portfolios and making decisions. And then you get the portfolio manager inside each portfolio making security selections and sector weightings. So that's why I like to call it the 2 levels of active management.
And that portfolio really takes like the So before you guys had the tilt models,
Mm-hmm.
we would have clients in, and then we would obviously, we have back office people that work directly with us from Gradient, and we would be doing that, saying, okay, where should we be moving this portfolio into? And what I like about the tilt is we have the smartest people in the room, conferring daily, weekly, whatever it happens to be, saying, you know what, we got to kind of move in this direction, which benefits the client tremendously because these changes are happening inside their account when they're not even looking. When the people that they're paying to look at it are doing exactly what they should be doing.
Yeah, that's huge, and that's very active management. You said, 2 levels.
It's active management, and it's an ongoing process.
Yeah,
right.
And the process is driven by the people who are deep in the weeds every single day in the investment landscape and the economic landscape, and they're analyzing all these things constantly.
Right, and they're watching it and they're looking at it and exactly doing the analysis available. So that's fantastic. All right, so Mr. Binger.
Yes.
This is going to be my number one question tonight. I can guarantee you at the holiday party. What is your economic outlook for next year?
Okay, so let me start this out. Now I'll ask you and Tony. I'll say, tell me what you see going wrong right now.
Currently, I don't see much going wrong right now.
I mean, the things we look at, I mean, the economy is certainly strong.
Yeah.
I mean, and it's actually starting to accelerate a little bit. We haven't hit that, the most widely anticipated recession that people have been waiting for never happened. So I think the Fed engineered a really, really great soft landing where inflation is under control right now. And the economy has stayed strong and the unemployment rate has stayed low. So I'm going to give a positive check mark on the economy. And I think that continues into next year.
Okay.
Corporations are flourishing right now. I mean, their profit picture is pretty darn good. So, we look at earnings growth and long-term averages of corporate profit growth is, 7-8%. And we're looking at a 15% number next year.
Oh, wow.
So I'm going to give corporate earnings a positive check mark.
Okay.
So,
yeah.
And then I think about I'm just going to call it the political landscape. I mean, we have a new administration coming in. I don't think it's any surprise that they're considered to be pro-business, kind of pro-economy. I could see things like regulations getting rolled back, increased drilling, which will keep the price of oil in check. As far as the markets are concerned, I think that's a positive for it. So as you go down and look at the list of worries, there's just not a lot of things. So next year, we expect the economy to continue on good. We certainly expect corporate profits to be strong. We expect government to stay out of the way of the business cycle and the economic cycle that's already in place here. The only thing that really concerns me next year is valuation. I mean, we've had, a couple of big years back to back. So I think we need to let the, profits in the economy grow into what the stock market has already anticipated. So I think we could see a little bit of a stall out, maybe even a 5 to 10% type of correction next, during the first 3-4 months of the year. But at the end of 2025, I still think the market is going to be higher than where it is today, but do not expect another 25% year.
Back to back is, I don't know what the stat is on that, Mike, but I would think it would be very rare to go back to back on something.
Yeah, it's low.
Typically, Mike, the stocks are right now, some of them may be a bit overvalued because of the huge increases we have had and the record highs that have been set. Would you say?
I would say valuation is extended versus history, but that's okay because the fundamentals have driven that valuation. So fundamentals drive valuation. So if the fundamentals change, valuation changes one way or the other. And we just see the fundamentals actually inflecting a little higher. So that's why we're still encouraged.
Sure. And you mentioned the administration, maybe if the new administration lowers corporate taxes, that could help.
I don't know if they're going to necessarily lower them, but I don't think they're going to raise them. And that was the fear that,
sure.
we have the Tax Cut and Job Act rolling off, and that would raise tax rates. And now I think that we'll keep that the same. We'll keep tax rates where they are, which business is plenty happy with where they're at.
Oh,
right now. Yeah.
But like a lower corporate tax rate actually allows you to hire, to grow, to do all of these things. Like it's generally a very big positive. And then those tax dollars trickle down. So if I get paid more, I'm paying a different tax rate than the corporation was paying anyway. I'm actually paying more tax if they're paying it down like that.
I mean, the thesis is that the administration is taking is, let the economy and corporate America and the consumer, let them decide how to allocate the taxes they're not paying to better spur economic growth versus the government.
Yeah.
Just a thought.
Yeah. Which makes total sense. Let me ask you this. What about, obviously we have a few global events still, smoldering out there, right? So how do you see those things affecting the market in 2025? Do you think these things continue? Do you think, is that a real headwind for our market, or is that more of for the, people investing globally and things like that?
I think it's more for people investing globally. I mean, Russia, Ukraine is one, but I mean, I feel they're closer to an end of that than, reacceleration, and we'll see what happens in the following year. The one I do think about a little bit is not the skirmishes between Israel and Hamas, or Israel and Hezbollah in Lebanon, but more of what if something broader happens between Israel and Iran. And the reason I talk about that is because that could disrupt the flow of oil. And if that happens, prices could spike, which oil's an input and a cost to everyone and everything, which could, hurt things a little bit. And look, our economy is growing pretty fast and things are pretty good. And, the government's going to spend and people are spending. I worry a little bit about, I think inflation is very much in control right now. Prices are still high. They haven't dropped, but they're not going up rapidly anymore. But what if they do start to creep up and inflation creeps up to the 3-4% range again? I mean, I think that's a possibility. And then finally, I think about China's economy. China is kind of in a world of hurt right now. Their economy is not doing well. They're facing an aging population. They probably wish they could rethink that one child per family policy they had back in the day. But you need people to grow. That's why I'm not that anti-immigration. I'm more pro-immigration, but let's do it legally and in a controlled manner. But China's economy is still the second biggest country in the world, and what happens there, affects the profits and losses of a lot of places. So I think we need to see where China goes.
Even the materials they make and the items they make that come back over here and those kinds of things. So.
Let's not forget tariffs.
The big topic of conversation.
Tariffs definitely slow certain sectors of the economy and raise prices, and it's kind of not good for global economic growth. But I think the administration is using tariffs more as a leverage for other things they want to accomplish versus actually, we're implementing these no matter what happens.
Right. And I think a lot of that is their sound bites for sure. And it's like any negotiating tool.
Right. Yep.
I'm 100% with you on that. I get to ask that question all the time. And I'm like, we're not, I find it hard to believe that we're tariffing anybody that like brings a product into the US. Like it just seems like, that seems like a lot, and we want people importing these goods and we want people selling them. We want, and that helps small businesses profit, big businesses profit. So we definitely want that. And I'm sure exactly what Mike just said. It's a negotiation tool of anything. And we'll see. We don't know how that plays out. We can just kind of stay in our lane and do our thing. And
correct.
And if something like that happens, we have to adjust and adjust accordingly. Right.
Yeah. But Rob, overall, there's really nothing all that sinister happening in the economy and the markets, globally. I mean, as far as investment markets and bond markets and all those kind of things, I mean, things are relatively good right now.
and they'd feel good, So I think I would concur. It's too bad, Mike, that you can't be. You've been in the eye of the storm a few times. You go like 10, 12, 14 years. Folks, there's going to be years where Mike is standing up there and the market's not doing so hot, and it's sad that he doesn't get the glory to come in this time when, there's no doubt everyone's going to be, having a cocktail tonight, very happy at the party. There has been ones where they're not so happy. So they're definitely going to be celebrating and you should be tipping a glass with them for all the hard work.
Yeah. Both you and I know that goes with the territory.
Yep, it does. It sure does. Yeah. Some years you just age a little bit more than others.
Fortunately, markets are up 3 out of 4 years, and you know what? We got to stand up and take it in that fourth year when things are not going so well.
And we're long-term investors, right? Yes. So we're looking long-term, but everyone has a little bit of short-termism in them. They definitely do. But
it's human nature.
Can't help ourselves.
Right. We cannot help ourselves. Yeah. But with that, Mike, I just want to say, I know you're super busy, and we appreciate you carving some time out because I know you're going to show us. You're just doing so much stuff. So we're so happy and grateful that you do carve out some time for us. I know the listeners appreciate it because you get real insight from the president of Gradient Investments that has literally been there, done that. He's been in this industry for 40 years plus. And has helped the growth of Gradient and definitely helped the growth of our firm directly. So we appreciate you, Mike.
My pleasure, and give everyone my best wishes tonight, and enjoy.
All right.
Okay.
We'll see you next time.
Great. All right. That does it for today's episode of Ready, Aim, Retire with our host, Rob Kirvan.